born and raised here in Burbank. Went to San Francisco Xavier, then went to Notre Dame High School, then I went to Loyola Marymount University where I got my Bachelor of Science in Accounting. So having that accounting background, I kind of looked at different fields and started in public accounting. What public accounting is, there's a couple of large firms. There's Deloitte & Touche, Ernst & Young, KPMG, and PricewaterhouseCooper. And what they do is they get hired by Fortune 500 companies to audit their financials to make sure that what companies are producing in terms of representation of their financials, their revenue, their income, that they're testing them to make sure, hey, are you telling the truth? There's companies in the past that have falsified or lied about that. Company called Enron. You guys were probably younger, but it was back in 99, 2000. It was one of the largest companies in the world, and they were falsifying. And so, needless to say, it's very important, especially if you're investing in the stock market, that you can trust that the information that's being provided by management is truthful. So I worked for one of the big firms. It's called Deloitte & Touche out of downtown. I audited companies like Boeing, Disney, and a lot of regional banks. And so it was a great experience, but it wasn't really where I wanted to go long term because a lot of the work was kind of in back office. You get to interact with CFOs and controllers, but then you had to kind of go back to a small room and crunch numbers for hours, and pretty painful. So I'm more of a kind of an outside person, like to get out, meet people, and interact on an individual basis. So I went back to an internship that I had over at a company called Morgan Stanley, and reached out to the individual that I interned for and said, hey, can I get a job? And he said, absolutely. I thought you would have come join me right out of college, but I assumed you wanted to do a little bit of accounting work. And make a long story short, this individual became my business partner. We've been working together for over 10 years, and so it's been a great partnership. So I started my career in the financial services industry at Morgan Stanley, obviously a large, well-known investment banking firm. And then about close to 5 years, this November will be 5 years, I switched companies to UBS for various reasons. Primarily, it was during the 2008 meltdown. There was fears that Morgan Stanley might go out of business, and my partner and I decided, we need to look at other firms to move our practice, our clients to a different house. So we chose UBS. UBS is one of the largest investment firms in the world. We manage about $1.6 trillion from funds from all over the world, individuals, corporations, and governments. It has been ranked as the #1 boutique private firm. We say boutique just because there's only about 7,000 advisors like myself here in the United States. And you compare us to Merrill Lynch, Wells Fargo, Morgan Stanley, Smith Barney. Those are all running at about 20,000 people, so about almost 3 times larger than us. So my team and I, comprised of a senior partner who's been in the business 26 years. I've been in the business going on 11, and then we have 2 assistants. Both are registered, so that means they can make trades for our clients. So if I'm not there, they can go ahead and execute those. And then I have one other assistant, Patricia. So it's a 4-person team. We manage about $300 million of clients' assets, varying from insurance companies, private schools, endowments, and executive, usually retirees from Fortune 500 companies like Boeing, Lockheed, Warner Brothers, etc. So it's a little background on myself. Married for almost 10 years here. I have 2 children. I have a 5-year-old and a 7-year-old, a boy and a girl. I coach, and so I keep pretty busy. And I'm going to be the chairman of the YMCA here down the street starting next year. And it's a big undertaking, so didn't realize that. But that'll keep me busy. So enough about me. I guess we'll move on. Before we get started, is there anything you guys want me to answer? Any questions? Any general stuff? Yes?
You mentioned you work with governments or advise them in investments.
So, so every team has a different kind of focus, different clientele. So my team does not deal directly with the governments, but we have a division. So it's a great question. So UBS is kind of comprised of 3 divisions. We have what's called investment banking, wealth management, and that's what I do is advise individuals on their wealth, and then investment management, where we have actual money managers and mutual funds. The investment banking is typically are the ones that will interact with governments. So let's say, for example, City of Burbank wants to expand the airport and they want to issue a bond. And so they say, we need about $30 million to renovate the airport or do some kind of expansion. So they go out and hire big firms like UBS or Morgan Stanley, Wells Fargo, and say, hey, we need $30 million. So let's say 3 of them each give them $10 million. They create paper called bonds, and then we sell it to our clients. So that's how we interact with governments. I know a couple Asian countries as well as European countries, they literally have deposits with us, and we interact and help them with their currencies.
Okay, so it's kind of like a mall, I guess, or like a website where you can choose what you want to invest in.
If you go to our website, you'll see the different divisions that our firm addresses. A lot of that is, it's all proprietary, it's confidential, and no one's going to disclose who we're handling money for, but we do work with governments and municipalities. Great question. Anything else?
With your accounting degree, like your bachelor's, were you able to find other jobs besides in that area, or was it just accounting?
That's a great question. So when I was in orientation, and my mom took me, and I had one of those pushy moms that was like, hey, you gotta do this, this, and that, but it's a good thing. It's helped me out. In orientation, they said there was 2 degrees that you could get a job very easily. It was engineering and accounting. She goes, you're going to be an accountant. I said, oh, sure. And then my second year, I started taking accounting courses, and it worked out. So I was very much employable. I actually signed a contract with Deloitte & Touche as a junior in college. So I knew before I even graduated, I had a job, and I got a bonus right off the bat. So that was unique. Not every degree provides that, but accounting is one of those that you can get pretty much hired anywhere, even as an accounts payable and finance department at any large firm will hire an accounting student. So it is a good background to have. So, anything else? All right, so I'm going to jump into financial planning process. So as a certified financial planner, there's certain metrics or certain rules we have to kind of follow by. And the first thing is, when we engage a client, we have to kind of establish parameters of what the services that I provide, so that it's, let me take a step back. The industry has evolved over the last 10, 15 years. Prior to the last, prior to the 10, 15 years, most advisors were known as stockbrokers. So if you wanted to buy General Electric or Coca-Cola or Apple, you just call us up and say, I want to buy these shares. Thank you. Something for an individual, okay? Then it evolved into wealth management, this idea that people had larger sums of money. And I think it really came about after the 90s. From 1982 to 1999 was the greatest bull market ever. And a bull market is when the markets go up for a long period of time. The opposite of that is a bear market, when they go down for a period of time. So a bull market, a lot of money is created. In the 90s, there was a lot of technology companies that went public. Silicon Valley just blew up, and there was tons and tons of wealth. So there was this need for people that, if they had 5 million, 10 million, 20 million, 100 million, they needed advice in terms of how do I manage all of that from a tax standpoint, how do I invest my money so it's secure, and how do I invest that to meet my needs. So there became this evolution from a stockbroker to a financial planner. So that's kind of just a quick synopsis of where we are today. So most of us who are in the business consider ourselves advisors. We advise people on their wealth. So we establish that relationship. In that process, we find out what's their financial situation right now. How much money do you have? what's your current working status? Are you retired? Did you inherit money? Sometimes, I get referred clients that they're a widow. Their husband just passed away and they just received a couple $1 million worth of life insurance proceeds. They have no clue. I have to kind of walk them through on how to manage that in that transition in their life. Because a lot of these widows maybe haven't even paid bills in 30 years. And it's kind of walking them to that next step of their lives. So we ask a lot of questions. We'll give a little quick intro of who we are, what we do. Typically individuals are referred to us by a CPA or another client that said, hey, go see these guys. So we'll sit down with them, just as if you go to a doctor for the first time and ask you, how much coffee do you drink, soda, do you exercise, all these things. We're gonna ask all those questions, but from a financial standpoint. Then we gather that data, analyze their investments, and then we come back and meet with them for a second time and say, okay, this is how we would invest your money. So if you have a bunch of cash, we would invest it in maybe stocks, bonds, and look at different products for them so that we can invest the dollars appropriately. And then the most important thing is after that we keep servicing them. It's not just a invest it and just forget it type of scenario. We make sure that actually with our clients, we contact them every single month. We give them a call. I have a scheduled call with every single client for typically about a half an hour, and we discuss, where they are from the previous month. I mean, is there any changes, any cash flow needs? I just met with clients in Simi Valley. They're doing some upgrades in their house, so they're like, well, we need money for the pool. We're going to build some other kind of deck. So those are things that we interact with our clients. And so they look to me to say, where do we pull the money? Where do we get the funds to meet those needs? I'm also discussing a lot about lending and mortgages because it's not just about the assets themselves, it's about the liabilities. So making sure that we take advantage of low interest rates that we have right now, and so that clients are optimizing that. So it just gives you maybe just a little feel of how we manage our relationships. I want to spend the majority of the time on the next two sections, which is investments and market environment, because I think that's what maybe intrigues you a little bit more of what you guys have been talking about in class. Ms. Garfield mentioned that you guys are doing a stock market game, and so why don't I start with what questions you guys have about stocks in general, and anything on your mind? Yes.
So what do you think of penny stocks?
Penny stocks, great question. All right, penny stocks are high risk. The concept of a penny stock is that they are typically not listed on one of the big exchanges like NASDAQ or the NYSE, and usually there's a unique story behind it. Either they're just a small company that didn't have a lot of finances to get to the big firms or the big exchanges. They weren't able to hire a company like Deloitte & Touche or KPMG to audit their financials. So there's a lot of reliance on what management's saying. So as an investor, unless you're privy or you know those individuals, like maybe it's like you say, oh, it's my uncle, he's a good guy, he's got this company, but he just didn't have the finances to really get to those exchanges. Sometimes there can be some great opportunities. Penny stocks tend to do well in markets like we've just had in the last 6-7 months, where when markets are going up, people are looking just for a quick turnaround, something that's going to go up really quick. The problem is when things go bad, they're disastrous. They will just literally vanish. They'll go to zero. So it's a high risk. Our firm has gotten to the point where unless you have $5 million, we won't even purchase a penny stock for you because they're just that risky. So.
Do you guys generally advise the person specifically about specific stocks? Like, for example, like say, hey, this company's doing well, so thus you should probably invest in them.
That's a great question. So I'm licensed to do that. I do not do that per se that much. When I say that, is occasionally there are some stocks that they come up, and I'll just say, hey, we should look at these. Most of my investments that I do are in the format of a mutual fund, an exchange-traded fund, or a separately managed account. So what I'm doing is I'm hiring someone to go and make those day-to-day decisions. They're there at 5 o'clock. They're making sure that they're getting all the data points and who's trading at what price, and then execute, and they have analysts that are meeting with management. They're doing a lot more due diligence than I am on making those day-to-day decisions, and it's a way for me to manage risk. The last 10 years have really taught me that it's not about making money, it's about managing risk. And what I mean by that is, going back to that penny stock scenario, you know, yeah, it's great, hey, it goes up 100%, but how do you know when to sell it? And it's managing that risk, because if that goes down to zero, what was the point? You didn't make money, you lost money. So it's about managing risk, especially when you're dealing with people that have millions of dollars. They don't want to lose money. They want to make money, but they definitely don't want to lose money. So my job is more about preservation of capital and making it grow at a certain rate. So I'm licensed to do it. I think with an accounting background, I can look at balance sheets and financials and do it. But I don't spend a lot of my time, because my time is more precious in dealing with clients, their lives and what they need, and making sure. I've had this year 6 clients take their kids to college this year, and we start making distributions out of their accounts to pay for college. So those are the conversations that I'm having with them about getting them their money, taxes, and more planning than anything. So, yeah.
How do you become certified?
So you have to have 5 years of education. They just increased that. It used to be 4, now you have to 5 years of college education. You have to do 2 years worth of working experience in the financial services industry, and there's, I believe it's 5 parts. It's estate planning, insurance, investing, retirement planning. Did I say insurance?
I think you did, yes, you did.
There was one other arm. So there's the 5 aspects of it. You have to take courses for them and pass each exam before you can even sit for the CFP exam, which is only given twice a year. It's a 2-day exam like the bar.
Okay.
So it's a high fail rate. Only 45% of people pass every time. So, any other questions? Yes.
I was wondering, like, a person, like a young person like me, let's say, like, getting started on investing, with like a limited amount of cash, like let's say up to 10 grand or whatever, what field would be like a good field to invest in to add on more capital so you could, you know, expand your opportunities and options?
Okay, so that's a good question, and maybe this will be a transition to some of the stuff that I want to talk about, because if I understand your question, basically you're saying, hey, where should I put my money being a young person, and where would I make money on the long term? Is that fair?
Yep.
Okay.
Just push that chair
I'm gonna move it over.
wherever you want.
How are we doing on time?
We're good. We're like half hour.
Okay. So have you guys seen the style box?
Maybe.
Okay. So we have large, medium, small, value, when, grow. Okay. So they have what's called the 9 style boxes. This is purely on the stock side, equity side. So you have large companies. We categorize large companies by their market capitalization. Market capitalization is taking the stock price, multiplied by the number of outstanding shares, and you get a market capitalization. So it's the theory or the concept of, if you had cash and you wanted to buy every single share at that moment, what's it worth? So large companies are typically north of $10 billion. Medium size or medium capitalization companies are going to be in the 10 to 5 billion, and small caps are going to be 5 billion and below. And you do have 2 other areas. You have what's called mega caps. Mega caps are going to be your Apples, your Google, just large. So usually about 50 billion or more. It's going to be the mega caps. And then you have small cap, and then you have what's called micro caps, which are even smaller than that. And they're usually going to be 500 million, really small type of companies. Okay. Then we rate risk by capitalization. So typically we'll say small companies are going to be riskier. And in our industry, risk equates to standard deviation. have they taken statistics or,
I'm not sure if it's had statistics.
anybody know what standard deviation is? Okay. But bottom line is, it's how much variation, so something that moves just a little bit in terms of, let's say, up 2% one year, then down 1%, it just stays in this range, that has low standard deviation. When you have high standard deviation, means you could get 1 year investments up 40%, but next year it's down 20%. That has much further, bigger range of risk. So the more volatility between the highs and the lows, the riskier it is, okay? Why is that important is that if you can get stuff that gets you 40% and maybe we can take some profits, that's where you're gonna make your money. So small companies, you got, Apple, Microsoft, all these big companies, they were small at one point. And when people got in with them when they were small, then they became medium, then they became large, and then they became mega. The people that were in there in the beginning made a ton of money. So to kind of maybe answer your question, you wanna maybe look at the small, medium-sized companies, because that's gonna give you the best total return over the long run. There might be years, like right now, large caps have probably been doing a little bit better than small caps, but I would argue over a 15, 20-year period, your small companies are gonna do much, much better, okay? Value and growth. It's a concept of value, are usually companies that tend to pay dividends. They're mature companies that they have consistent cash flow. There is some growth on it, but they're not, investors are buying them because they're a good company, not because they're growing fast. So I'll give you an example, Tesla. Anybody heard of Tesla? I'm sure it's a popular stock right now. If you look at their financials and their numbers and how many cars are producing the profit, you scratch your head and you say, how can they be worth so much? That stock is soaring. That's a growth stock because it's a growth story. It's this idea, this concept that it's not about how many cars are selling now. It's how many cars are they going to sell in 5 years? How many cars are they going to sell in 10 years? And how are they going to expand that product line? So you're buying that for the growth story. So we base it on valuation. Do they get much into valuation and PE ratios? Okay. So I'm going to just keep this really high level. It's just, like I said, it's more about a growth rate. So that might be a company that's growing at 30 or 40%, or a value company might be growing at 5 or 7%. Value and growth becomes important to us as advisors because it's all really driven by the economy. So in the 90s, when you had investment banks that were giving tons of money out, and a lot of IPOs, it was all about growth. You had companies like Stamp.com, Pets.com, companies that had no revenue, no even ability to make money, but the stock would just soar because it was this idea of it's the next big Cisco, it's the next big Intel, it's the next big tech company that's going to make tons of money. And so it was all about the growth story. So at that time, as an advisor, I would say, hey, if I want to make money for my clients, I might put a little bit more money in the growth side. Then you had a period from about 2002 to about 2007. It was all about value. And the value is also this concept of, I buy a company that's been beat up. Some might even argue Apple's a little bit of a value right now. They got $150 billion in cash. It's a stock that was at 700, now it's in that 450 range. And they just need a catalyst. They need something that all of a sudden takes them forward. Is it an iPhone 6? Is it some other product that gets them back into a growth story? So value is you buy companies that just kind of fall out of favor, but they're a good company, good cash flow. And so we look at different opportunities in the economy. So when a market, let's say we go through a recession and the market kind of gets beat up, we might start looking at value companies. So like right now, I'll give you an example. I'm buying value European stocks. For about 2 years, Europe has been beat up and they've had a really bad recession, issues in Greece, Italy, Spain. I'm sure you've been hearing about this. And now they're finally turning the corner. We're getting economic data that says unemployment's better. You're seeing manufacturing improving and economic activity. So we favor value on that side. That make sense? Okay. Any questions regarding style boxes? Yes.
You said for like big companies to raise their value, they usually come with good products, right? When Apple, when you started selling the iPhone 5C and S, its stock went down. It never go up.
It went down for 2 days and this lowest back up.
Yeah, it went, the day that they started selling it, it went down.
Yeah.
But then after the time that was like, they were like, for the 2 days that everyone thought that would go up, it went down, but then after that it started going down.
So, let's address it. The reason they went down, it goes back to the growth story. When you look at their margins, and a margin is what they sell it for and what their cost of the product is. When they came out with the iPad, that just changed everything for them. Because all of a sudden they were making tons of money on this product. Nobody had it, they had no competition. And so they just took over. So anybody had an iPhone, they went and bought an iPad, and they bought multiple iPads. So their growth, their revenue growth was just rapid. So all of a sudden they were, in one quarter they were at 25% growth rate. They went to 35% growth rate, 45%. So not only were they making more money, but they were growing it at a faster pace. The problem with the newer phones is their cost has gone up, and they've had to lower the price to be competitive against Galaxy and some of these other newer smartphones. So they're losing market share. They're still selling a lot, they're still making more money. It's just that it's at a slower pace. Excuse me. Throat's getting dry here. So when I have dollars to invest with a company, and I looked at, yeah, they're making more money, but it's at a slower pace. And it's gonna get to the point where they're not a growth company anymore, they're more of like a value blend type. So when that news came out, I think there was this hope that they would have this revolutionary product, something just unique. And I just can't even fathom what it is. Maybe it's like they can produce 3D videos or something. And everyone's gonna be like, oh, that's a huge market opportunity. I think there was that expectation. So when it was announced, people just said, done, they sell it. But then you're gonna get the people that are value buyers that start saying, whoa, hold on. It's still a good company, they have lots of cash. It's a good long-term buy. So a value player or investor is probably gonna think more long-term. A growth, you ride it when it's hot. You got Netflix, you got Chipotle, you got some of these companies that are, you tend to see they're technology companies, energy companies, where there's just an explosion over a period of time. You jump in there and that's a growth story, and you ride it. So frankly, right now, Apple's, the growth story's over. They're just a large, mature company. We knew it was gonna happen at some point, just never thought they would get to 700. Yes?
Those growth companies that like suddenly start going up, do those investors think about how like over time it's gonna go down, or do they just?
It depends on when you get in. Like right now, for example, there's a lot of small biotech pharma companies that are coming out with like a new drug, and there's companies that are up 200-300% this year alone. So when you're, let's say you're a large shareholder, like you were one of the founders, maybe you start looking to say, yeah, maybe I sell a little bit of it. But for them, it's their nesting, it's their wealth. So I think it varies by industry. So with them, they're hoping Amgen or Johnson & Johnson or Pfizer or Merck, some of these big pharma companies, buy them. And then it's like, it's an automatic way of diversifying. They either get cash or they're gonna get new company stock. If it's like Apple, it just depends. I mean, if people bought it at 99 and now it's at 400, I mean, it's still a great investment. They still made a ton of money. I mean, sure, everyone looks at that $700 value and say, God, I wish I would have sold it there. But there's always lots of cases. That's why my job as an advisor is to always tell clients, we never want to be fearful and we never want to be greedy. Can't be either. We want to kind of take that emotion away. If we can do that, we're going to make money over time. Not trying to hit home runs, just trying to get on base and trying to do kind of a baseball analogy, but just be consistent. I'll give you an example, like Lockheed. I have a lot of clients that either inherited Lockheed or former retirees, and they have large positions. I have a family up north, about a $15 million net worth, and they all had about $400,000 or $500,000 of just Lockheed stock. Well, obviously we're in an environment where we're not in a Cold War like we were in the 80s. We're hopefully and probably on the outskirts of ending wars, and there isn't a big demand for more missiles and more military products. So you look at Lockheed and you say, there isn't a growth story there, that there's no potential, so how do they manage that? But the stock has gone from $80 to $122. Just keeps going up because they're still generating a lot of cash flow. But I have to tell them, all right, let's start taking profit. That stock could still go to 200, but I don't want to bet on that because I'm afraid that it goes from 120 to 60. So what I try to do is I try to sell those over a period of time and diversify. So, yes.
What exactly is a blend stock?
It's something that's kind of in between. It's not quite just the growth and not quite just the value. I'm not going to get into too much of how there's like discounting cash flow models. Have you talked about discounting cash flow?
No.
So when you're analyzing a stock, you're going to look and a stock price, basically an indication of future growth. So, for example, Boeing right now is at, I think it's like $118. So there's a future expectation that they're going to continue to have, they're going to sell more planes and growth. So if you were to sell that company for the market capitalization, there would be what's called a premium. There's excess cash there. So it's not book value. So it's really based on future expectations. So that's why sometimes when you hear about earnings and a stock goes down 15%, it's not that they didn't make money and they're going out of business. It's just that their future expectations not that strong. So a blend, you might look at a certain company, there's what's called GARP, growth at a reasonable price. So you might have a company that says, well, it's a growth story, it's a growth company, but it's not like a Tesla where it's like, it's just soaring. You might have a GARP that's like a Lockheed or a Boeing where the industry's not growth story, but it's growing faster than some of its peers. So it starts to kind of fall in that blend area where not necessarily growth and it's not necessarily a value. That's where you get a blend.
So a value would have a lower PE ratio and growth would have a higher PE ratio.
Correct, absolutely. And just to touch on, PE is price divided by its earnings. So earnings, you know, is a set dollar, but if all of a sudden that price is higher, that means that you're paying more for that company. It just goes back to that Tesla story. Like right now, wish I had the numbers off the top of my head, but there's been comparisons to like Ford, and Tesla is either valued more or about almost as valued as much as Ford, but only Ford does like 1/20th of the number of car sales. But it's about the growth story. It's about that expectation that Tesla is this whole new market environment, and you're gonna have new buyers. So, all right, let's see here. What else? How much time do I have?
Stood out like another 15.
Okay. Bonds. Anybody know what a bond is? Yes.
Bond is, it could be corporate, it could be government. It's basically a loan. It's like, say if like an entity wants to get a large sum of cash in a quick amount of time, they'll just basically advertise, hey, $30,000, if you invest $30,000 in us, we'll pay you back that $30,000 with interest, and then they get to invest it into something else.
Exactly. So a bond is when you lend the money out to somebody and they give you a piece of paper, says, an IOU, I will pay you back at a set date, might be 30 days from now, might be 30 years from now. So they do vary, and they're gonna pay you interest for, during that period that they own the bond, and then they pay you the principal back. So bonds have a lower standard deviation. They tend to move a lot less than stocks. So we look at stocks for the potential of growth, but also a little bit of income. Anybody know what we call the income that stocks pay out? Sorry? No.
Dividends.
Dividends. So capital gain is when I buy an investment, say for 10,000, and I sell it for 20,000. That difference, that 10,000 on top, is called capital gains. And you realize that, or you recognize it when you sell it, because that could also go away, you know, go from 10 to 20 back, say, down to 8. The dividends are important, and it has become an important investment decision really for investors over the last couple of years in an environment where interest rates are really low. Anybody know what the 10-year interest rate pays right now? The Treasury? It's a hard question, but I don't even know. Okay. So the 10-year is right around 2.7%. 10-year Treasury. It's one of the most widely quoted rates out there. Why is it important? The 10-year Treasury rate is what most banks will use to calculate mortgage rates. So, for instance, right now, a 30-year mortgage it's going to vary from bank to bank, but it's going to be probably right around, say, 4.75%. So obviously we have a difference of about 2.05% here. Why is there a difference? Banks can go and borrow money at 2.7% and lend it out for 4.75%. That's how banks make money. This is how they make their money. Okay? So they really work as a middle person. And in some instances, they're actually making more money because if you have a savings rate right now, I think JP Morgan pays about it would take you 100 years to get 1% at 0.01%. Basically not paying you anything. So they have anybody who has deposits at Chase. Chase takes that money and goes and lends it out here. Do you think they're making a lot of money right now on the difference? Oh, they are. They're borrowing money at 0.01 and then lending it out at 4.75%. They're making a ton of money. So the 10-year interest rate has a lot of impact in the market. It's what people borrow money at, so like mortgages, car loans. If I'm a government or if I'm a municipality like the city of Burbank and say, hey, we want to do this new infrastructure, we want to build a new freeway, we want to do something, well, let's issue bonds. If they can issue it now at lower rates, that's great because the cost of borrowing is at all-time lows. Just to give you maybe some historical perspective, I'm just giving you raw numbers. I don't want anybody to quote me on this, but basically for the last, I think it's like 250 years, there was a period where rates were like this, and it spiked, and came back here. This was from about 19, give or take, 66. The peak, I think it was about 83 or 84-ish. Okay? So interest rates went so high, you could get CD rates for about 17, 18%. 18%. You could buy government bonds for 30 years, paying you about 14, 15%. There were people that refused to buy 30-year bonds for, say, 13, 14% because they could get 17, 18% CDs for 1 year. And this was really driven by inflation. Have you guys talked about inflation? Okay. I just want to be able to wrap this up. What time am I done at?
12:15, we'll leave some time for questions.
Okay, cool. So, just bottom line, and kind of go with it. For 30 years, interest rates have been coming down. And now we've hit this point where rates are really, really low. So what we have been doing is advising people to borrow money. So if you have a mortgage, because sometimes people say, well, I want to pay off my mortgage. Well, if I can go and get you a mortgage that's in that 3 to 4% range and manage your cash flow, we can take that money and invest it and do other stuff. Over the long run, we're going to make lots of money. What we're trying to advise our clients not to do is to be on the other side of that. And what I mean by that is, if one person's borrowing, someone is lending. So we're trying not to load up or own a lot of bonds, especially long-term bonds. Because there's a relationship where the longer the maturity on a bond, the more volatile it is. So if I go and buy a 30-year bond paying, say, 3.5%, and interest rates go up, that bond price goes down. Let me actually just show that as a kind of a chart. It's a interesting phenomenon, and I think you guys should know it because it's going to be really important over the next 5 years as interest rates start to go up. So it's rates, bond price. So as rates go down, bond prices go up. So that's what was happening from here. So owning bonds from the 80s all the way through, even though the stock market was phenomenal from 82 to 99, owning bonds was a great investment because you made a lot of money. The opposite happens where when rates go up, bond prices go down, okay? Why is this important? I'm dealing with clients that are investing their money, and they're investing it for a long term. This only happens in between when the bond is issued and when it matures, okay? If a bond is issued for $10,000, when it matures, it's going to be worth $10,000. The problem is, in between all those years, especially let's say you go over a long period of time, that bond's going to fluctuate. So it goes through this cycle here where so when rates go up, the bond prices go down. So I've had bond portfolios that are down as much as 8 and 9% in 1 year. That's just unprecedented. It's the worst 3-month cycle that we just went through in the past 50 years. And it's only going to amplify and get worse over the next probably 5 years. So every time Bernanke talks about tapering or stopping quantitative easing, and there's discussions about rates going up, you're going to see a lot of volatility in bonds. Why is that important? It's because when clients get their statements, they say, why did I lose $50,000? Or why did I lose $25,000 when the stock market's going up? It's because your bonds have to be marked to market. They have to reflect what someone's willing to buy for it. So if I bought that 30-year bond at 3.5%, and you fast forward, let's say 5 years from now, a 25-year bond, because obviously we bought a 30-year bond 5 years have gone by, is paying 6%. Which one are you going to want, the 3.5 or the 6%? You're going to want the 6%, right? You're going to want to get paid more. So that 3.5% bond has to go down in value to reflect the comparison to get a total return, because not only will you get the interest, but you're going to get appreciation. So that goes back to the bond price will come down. If the investor holds on to it for 30 years, there's no difference. They're still going to get the principal back and all that interest. The issue is that during that time frame in between, as rates go up, the bond price goes down, and so it becomes very challenging for them to realize the fact that they're losing it from a paper standpoint, but it will recover. It's just a lot of volatility. So we're managing through this, and that becomes important in constructing portfolios for clients. I know it's not really exciting, but kind of important.
So can you explain again how the mortgage rate actually affects how the 10-year treasury rate affects the mortgage rate?
So, our country is kind of one of the unique ones where home ownership is extremely important. We've had, our politicians have been very proactive. This is for decades, going back to probably the 50s or 60s when they created Fannie Mae and Freddie Mac, which are GSEs, are called government-sponsored entities, and they help provide liquidity to the mortgage market. So it makes the cost of borrowing money easier. So when the 10-year interest rate goes up, mortgage rates go up. Well, if I'm going to go out and buy a house, that impacts what I'm willing to pay, because people don't pay cash for a house. Typically, they don't. They take out a mortgage, so they put a down payment. So if my mortgage payment will go up, say $500 more a month because the interest rate's up, I might not be able to buy a house, or I might not be able to buy that house, I might have to downsize. So it impacts real estate. Why is that important? Real estate is important because it's one of the, for a lot of Americans, that's the single most, biggest asset that they own. It can be anywhere from a couple $100,000 to million plus, especially in Southern California. So real estate has a big impact on just the overall psyche of Americans, in that when their house is worth more, or they feel like they have equity, they will spend more. They will make confident decisions about buying a car or sending their kids to college. So the impact, it goes back to the borrowing rate. So when the rate goes up, the cost of borrowing goes up, and so your payment, your interest payment every month is higher, so you can only make a certain payment, because your salary is fixed.
Yeah.
So that's why Bernanke has been keeping that rate low, is so that the cost of borrowing for mortgages has stayed low.
Why don't the banks just that doesn't make sense, do the banks invest in the treasury bonds, but that wouldn't really make sense because then they're losing cash.
So let's say the rate skyrockets and goes to 6%. If they wanted to borrow, because that's the borrowing rate, the treasury rate,
yeah,
because it's the safest investment. So if JP Morgan wants to go borrow $20 million, $50 million, whatever the dollar amount is, they're going to borrow it at 6%. They're not going to lend it out at 4%. They're losing money. That's why they have that margin.
Yeah.
That's the difference. That spread is how they make their money.
Yeah. Okay. Thank you.
Question.
I was just gonna ask, how, you said that you guys are in charge of managing the rates and bond prices. How do you guys manage that? Like,
Okay,
what's
so-
your strategy? Easiest strategy?
So my strategy on how to manage the risk of that is, it goes back to interest rates. This is called a normal yield curve. So this is the rate, and this is time. So the further out I go in time, the higher expectation I'm going to get paid. If I'm going to lend you money for 10 years, I expected you to pay me more than if I would have lent the money to you for 1 year. So what we try to do is we try to stay in this range of investing people's money. It's usually anywhere from 3 to about 8 years right now. It's a time frame, because as rates go up, my maturities are getting closer and closer, and they're less volatile. If I go out and buy a bunch of 30-year bonds and rates skyrocket, these bond prices are going to drop dramatically. So that's how I try to manage the risk. I'm giving up maybe a little bit of income, a little bit of interest, because I'm getting paid more right here, but over the long run, I can manage the volatility. Yield curves can change for a period of time. We've had flat yield curves where you almost got no increase, so it made no sense to go out there. And then when you get an inverted yield curve, where short-term rates actually pay you more than long-term rates, that's a bad sign. That usually means a recession's coming on, because investors are saying, you know what, I'm going to go on by 10 years, I'm going to lock up my money because I know bad things are going to happen over the next 10 years. I've seen that twice in my career, and every time the yield curve goes inverted, where short-term is higher than long-term, a recession is always coming. Let me just throw out a couple things on helpful tips. Sorry. Get internships. You guys can, even at the high school level, try to get exposure out there. That's how I got in my job, was an internship. I did it for a month. I hated it, but it made a career. Because what I did, I didn't realize it at the moment, was just such a great experience. It got me in the door, and I met great people, and they opened opportunities. It's not always about the stuff you know, it's the people you know. I know it sounds kind of like a corny phrase, but get to know as many people, especially in the business world, it's a special industry. I'm sure a lot of you are thinking about colleges and fields and stuff. One area that over the last 15 years has just been so popular, but from what I'm reading out there, it's oversaturated. There's too many people, and it's the financial industry. I know it sounds a little weird coming from a financial guy, but there's a lot of people that say, hey, I want to work at Wall Street, I want to do investment banking. The problem with that is we're in an environment right now where we're still not taking on much risk, and investment banks and banks alone have shrunk the number of employees they have. The opportunity space has shrunk. Where do I see opportunities? Domestic energy. Have you guys been researching to hear much about U.S. independence, energy independence? Okay. I would strongly recommend researching, just Google it. There's a lot of research. It's been a new push here over the last year or two. There's a lot of domestic energy here in the United States. So much that arguably we have more than the Middle East and some other countries alone.
You
So-
talk about natural gas as well
Natural
as
gas,
oil?
oil, shale oil, the oil sands up in Canada, just in this North America and even the shales. I know there's a lot of controversy, there's even movies about, how they take the energy out. But the reality is, it's being taken out, so rapidly. I'll just give you an example. In North Dakota, there are kids that are dropping out of high school because they can get a job for $150,000 a year just to drive a truck. There's such a demand for getting this oil out of the ground. And the oil companies are gonna have so much of it that they're willing to pay $25 more a barrel just to transport it by train from North Dakota out to the refineries, usually either in Texas, California, or in the Northeast. So it's growing. And it's growing so much that it's impacting manufacturing in the United States, especially in the Midwest and the Southeast, because there's cheap land and now cheaper energy. Companies like Volkswagen, they're building the Volkswagen Passat here to ship it back to Europe because it's cheaper. Toyota is building Tundras in Indiana because it's cheaper here, and not for sale here. It's to sell it in other parts of the world because it's cheaper to build it here. So I would look at engineering in that area, energy. I think those are two areas that are really gonna expand here in the United States and create some. There's gonna be a big job demand for it, and there's a shortage of it. So a little tidbit there. Any other questions before we wrap up in 2 minutes? Yes.
I myself wanted to be an engineer. Well, not wanted, but that was a particular field that I kind of want to be. But now I'm going to business administration because I want to be more of an entrepreneur, and I want to get the general basics of business, such as accounting, marketing, and other aspects of it. Are there any advices for a future business administration student?
It's going to be important that you understand dealing with people management. So much of our society is about relationships. So if you take good management courses, put yourself in a position where you can be a manager and get that real life experience. Internships are going to be really important in that capacity. So I would take advantage of that. You have a question?
Yeah, I was wondering if individuals come back or treasury, just regular average person.
Well, no, right now, the U.S. government is running a deficit, a really large deficit. It's gotten a little bit better this year, partly because we have higher tax revenues, government's grown a little bit, and then actually the government made some investments back in 08 and 09 through a program called TARP, if you guys remember that. But those investments have now produced profits to the government. So those profits and that extra cash has produced a smaller deficit, but we're still running a deficit. So right now, no, the government is actually borrowing money from people, from us and other countries. Any other questions? Yes.
For I want to measure your business, but in the long run, I want to become like a CEO or a chairman of the company. Do you think that is not a good field to go to, or it's going to take a long time to know?
No, I don't want to discourage anybody from that standpoint. Here, people that I've seen very successful in that didn't major in business out of college. They went back and got their MBAs. They majored in something else. Maybe fall something that you're passionate about. I know it sounds kind of crazy, but I've had a couple good friends from college that they were history majors, or they were, one was a Greek and Latin history special. And it was so unique. The reason it just makes you very intellectual, you become a very good writer, communicator. And then you get the business courses later on, and you might be ready to learn it. Because when you're in college, you're coming, I mean, you're what, 18 to 22, you have no real life work experience. So think about maybe majoring in something else and then getting your MBA.